I'm going to radioactivetrading.com. This is the website that follows the blueprint, of course, and you can see the RPM reports and so forth, new married put positions similar to search tool and power options, lessons that enhance what's in the blueprint, excuse me, help new blueprint owners get up to speed with that. And then Ernie and I post our actual trades here for the structure. Here's the Arista position. Oh, it was 1540. My apologies. So about the March 125 for 1540. That was an initial risk of 8%, or I'm sorry, 1087. That's where I was getting the 1087. That was my maximum risk, not what I paid for the put. Gotcha. Okay. So that's what the position opened on October 4th. And on 11/1, we were able, the stock moved up to 126. So we moved the 125 put up to the 130, and that dropped the risk down to 6%. And on that same day with the stock at 126 after the strong earnings report, yes, this was done at a debit. It cost me $260 to roll up the put from 125 to 130. But it gave me a 5-point higher payout, so it would reduce the risk from 8 to 6%, because I'm gaining more as a higher guaranteed exit that I had to pay into the debit. This is what we call income method number 4 in the blueprint, one of the 13 different income methods. And then, yes, a simple income method number 1, sell to open the call for $385 to help cover that initial debit of $2.60. Everything was good on November 1st. We lowered the risk from 8% down to 3.4% in 30 days. Great risk reduction of 4.6% in 30 days. I like it. The position looked strong as far as, oops, sorry, wrong view there, folks. The position looked strong as far as what I wanted to see for risk versus potential max return on the 18th of November, meaning, oh, these aren't the right, I'm sorry, these aren't the right prices. My apologies. It shows the risk down to 4.5%. This is in the webinar account. The share price is a little bit off. That's why the risk's at 4.5. But the peak return is still around 4.5% with a max risk, as we saw back on Fusion, of 3.4% on the position after selling the call. But it was the 130 call, and then this happened this morning. So what did I not do? I did not do a knee-jerk reaction. Sometimes you don't want to overreact too quickly. Do I want this position to be assigned after being in it for only 30 days and making 4.5%? No, I think Arista does have more upside room. I think it's a good married put position, radioactive trade, to continue to milk with different income methods, 1 and 6, maybe potentially a 5 I was considering as well. I know some of you might not know what I'm talking about with that. But I didn't want to overreact as soon as it jumped up to 133. I think the top was 133.70, because it would have cost me $630 or $640, I think I saw, to buy to close this call. So it would have been a debit of about $260 to close the call. But now I've got to roll to another strike to make sure I'm rolling for a credit. And to get to the 135 strike, I may have had to go out to February. And I'm holding a March put. So I didn't want to do that. January was close. I could have rolled to January for a small credit. But I didn't want to go too far out. So as we saw, I just let it sit. Didn't want to overreact. It came back down just a little bit below 130. Could have bought it back here towards the end of the day. And I think the low price, we'll take a look at that in a moment. At the low price was only 310 or 305. Pocketed 70 cents, and I could have rolled up to the 135. But I didn't, and it stayed in the money, and I'm okay with that in this case. So what can we see here? It ended at 495, so I'm still down 110. And yes, my put declined as well in this case. Excuse me, folks, my apologies. So, but still looking at a good liquidation value right now in this position. Let's take a look at the true liquidation value from the portfolio. I'm going to go to position actions and then position analysis. Okay, and so yeah, liquidation is only 1.8% right now. The potential to make 4% if the stock stays right at 131. Now that's 14 days away. So I can guarantee you I'm probably going to take action at this time. I'm sorry, before then. That's what I meant to say. But one thing about this here I wanted to just look at real quick. I could go to the research tool in Power Options and go to the option research. I wasn't watching this the whole day. That's not what I do. I was doing other things all day. But yeah, the last price was at 460. That was the last trade price at 337. Oh, it was higher than I thought. I missed that. So I thought the high price was around 620 or 630. It was actually $7. And the low was 390. That I saw it low. I swear I saw it low now. I saw where I could have bought it back for a profit today during just the session. The graph here is just showing me day by day and close prices. I thought I saw that as low as maybe 360 at one point when it pulled back down to 129.20, 129.30 in those cases. So that's where I was getting those numbers, but I want to show the research tool so you can take a look and reevaluate, the high and low each day. And for those of you that have the historical, of course, you could go back and look at this on the option chain and see day by day what was the high or low or last price also for that. So let's go back to the position. Let me clean up some of my tabs, folks. Thank you for bearing with me. And we're going to address the next question that came in. And keep in mind, why am I satisfied with this position now with a risk of 3.4% with that max return of 4% if it's on around 130, even though it's breached that, I might need to manage it just as you likely would with a covered call. Essentially, that's what I did. I sold a call which became a covered call against the married put structure. Now remember, I opened this position. This might not give me the full reach. We opened this position on October 4th. And the stock was about the same price. I'm sorry, the stock was around 120-ish, so it was in this range. It went as low as 98, and I never had a loss of more than 4.5% on this position because of the married put. This movement here, I know it doesn't look like a big movement, but one of these two movements here, I think it was this one, was related specifically to Meta, or it might have been this one. I'll have to check the date on that. I'll just do that real quick while I'm here. Sorry. But this was related to Meta's earnings, Facebook's earnings, which many of you remember were disastrous, and it dropped about 25%, if I'm not mistaken. I think it was at least 22. It could have been 25 or more. So somewhere around the 17th or 18th or the 20th or 21st of October, or it could have been this one here. Why did ANET move up when Facebook's earnings were so terrible? And the reason why is because in Meta's guidance, I'm trying my hardest not to say Facebook. I really want to say Facebook instead of Meta. But in Meta's guidance, they said they're going to continue to increase spending into the quote-unquote metaverse, into the different cloud support structures, which means that in the next couple of quarters, those cloud support structures that are being used by Meta are going to see an increase in payments, which was Arista Networks. I think there's one called Cloud Source or Clouds. It wasn't Cloud Strike, but it was Cloud Source or something else. And then there was a third one. So these three stocks all jumped up, even though Meta fall, because in their guidance, they said, we're increasing our payments into the metaverse cloud systems by, whatever it was, whatever insane number they come up with, going up to 23.6 billion, I think, from maybe 18 billion or 16 billion, whatever it was. And this movement was related to more directly. This, I believe, was Arista's earnings itself. It had a lag, but then it came back up. And this was the movement today, the sudden jump up, which I think the only news I saw on it was that it was added to different IBD watch lists. It was already in the IBD list, which is why I got into it in the first place, because it came up on the married put default search on Power Options. Again, though, and that's what happened with this position. Now, Victor asks the question. Let's go back to square one and talk about this a little bit more. What is the married put structure? Well, the married put is our preferred structure that we use when we want to be long a stock long term, but have controlled risk in place for unexpected markets. 2020. 2021 was some good movements upwards, sort of a melt up with a little bit of drawdown. And then 2022 has been just an unknown, uncertain market. Ups, downs, 25% down, 26% down, back and forth, back and forth. Not all at once 26% down, but your 401ks, your accounts have seen it as well. Following the rules in the full course that's called the Blueprint, the proper structure to set up the married put trade. And then the 13 different income methods we use against it. Now, as we saw, on October 4th, the original position that we used for ANET, which matched the search criteria, the default search criteria on power options, the stock was purchased at 120.47, if I'm not mistaken. Let's verify that. Yep. And at the same time, in October, this was roughly 170 days away, it bought the 17th of March, slightly in the money, 125 put at 15.40. So this, I could have gone to the 130, and I was considering at the time it would have given me a risk about 5.4 or 5.5%, but I was okay with keeping closer to at the money. In this case, we usually go in the money to keep a controlled risk in single digits. That's why we're going in the money. A lot of that's explained on other videos, and I'll show you a free white paper in a second. But there was the original position. Total investment, $13,587. The put guarantees me a floor. If the stock fell to $10 per share, I'm still guaranteed that I can exercise my 125 put, even though it's out to March, or I could just sell to close it, liquidate the position, and I can't lose more than $1,087 or 8% on the position. Instead of a covered call with a capped gain and continued risk to the downside if the stock falls, here we have the controlled risk to the downside and an unlimited risk to the upside. Now, the first move that occurred, the stock moved up above 125. Now, let's think about this for a moment. When I originally got this position, the max risk was 1,087 per share. This maximum risk is the time value. Did I pay $15.40 total for this put? Yes, I did. But of that $15.40, $4.93, yeah, is intrinsic value because I'm buying the 125. The remaining 1087 is the time value or extrinsic value. That is the true risk. When the stock moved up to 126 on, and I almost did this prior with the last move up, but I did it this time, on November 1st, excuse me, sold to close the put at 1220. Okay, so let's add that put back in at 1220. So just closing this, remember my original cost basis was $1247. I'm sorry, $12,047 or 120.47. Now it's up to $12,367, even without buying the other put. Did I lose $320 on the put because it's at a lower price? Yes. But remember, when I entered this position, the original married put structure, this time value or extrinsic value was 1087. We had $4.40 or so of intrinsic value on this. I'm sorry, $4.03 roughly. $4.53, excuse me, of intrinsic value. So we were only paying 1087 of time value. Now with the stock at 126.10, the value's at 1220, which is all time value or extrinsic value. So even though I lost on the put, I had to gain $6 on the stock to lose that 320 on the put, roughly $6. How can time value or extrinsic value increase? And that's one of the three core principles of radioactive trading, the at-the-money bell curve. When I bought the put, the stock was at 120, and my 125 put was in the money. The at-the-money put, the 120 put, would have had the highest time value. Now that the stock's at 126, my 125 put is here, near the peak of the at-the-money bell curve. So I actually saw an increase in extrinsic or time value. Did I lose 320 on the put? Yes. but I gained almost $6 in the stock for that 320 loss to happen, and I gained 12.20 in time premium. Now you might ask, why is he throwing all these numbers at us and babbling? This is the advantage of this income method number 4. I am paying a higher price and I am going to increase my cost basis, but I'm swapping time value. I had an increase of roughly $2 and $2 and some in time premium, $1.40, I guess, really, in time premium. And I'm going to buy a new put, same expiration in this case. And our price was almost $14.80. Is that what I said? Yep, $14.80. Oh, sorry, folks. Okay, so we bought one, just moved up 5 points, but bought it at $14.80. But $8, remember the stock was at $126. $4 of this was time premium. $4 roughly. The stock's at $126, we're at $130, $4 that. So it's another $10.80 at risk. But we gain here in the payout. Another way to look at it is, remember, that $15.40 I paid for the initial put was already accounted into the cost basis of the entire position. I'm going to pay $260 here, increased debit up to $13,847, but now guaranteeing a 5-point higher payout. So I've lowered the risk by that $240 down to 6.1%. And then we sold the call. Okay, so we're taking advantage of the at-the-money bell curve, the time value of the at-the-money bell curve, as well as proper position sizing to now control the risk down 2% from where we started, from 8% down to 2%. I did add to cost basis. Now, Victor said, why not another income method number 4 when ANET gapped up? Absolutely. Had I just done this, and Victor saw why, but had I just done this by itself initially on November 1st, and this morning I saw the market gap up to 133, I would have got different prices, but I probably would have done the same thing again. We'll use closing price. I would have sold this 130, lost money on it, it's up to 1260, and maybe gone up to the 135 or the 140. I'm rolling up again. I'm going to pay another debit of $2.50 to get another 5-point higher payout. Would have reduced the risk again to 4.2%. Yes, Victor, I probably would have done this initially. I would have done this today, if not then. What I mean by that is I decided that I wasn't expecting this gap up. I was expecting ANET, when it was at 126, to gradually move up over the next few days, some ups and downs with the market. My target for this in November was right about where it is now, around 131, 129, small increases as it had been doing. Again, as I mentioned, to help pay for the debit that I just enacted with income method number 4, the first one by itself, we sold the call for $385. And that's the position I wanted, 3.4% with a potential 5.6% profit. I must have not have been accounting for the income method number 4 when I showed that call earlier when seeing the risk of 4.5 and 4.5. My apologies. Okay. Now, this is the current structure as I have right now. And then Victor commented, so this is in the blueprint. I did income method number 4 and moved the put up. Then I paid for most of that debit with the income method number 1, simply selling the call against it, which most of you know how to do. But there are rules to do it in the blueprint. Why is the blueprint important to know how to do all of this? A common mistake that I see in accounts where power options users try to implement this technique without the use of the blueprint. They say, hey, I don't need to buy the blueprint. I've seen Mike do this enough on the webinars. They say, hey, Mike can reduce his risk almost by about 1/3 to 1/2 every time I've seen him do this income method number 4, roll the put up. I don't care if it goes for a debit in this case, simply because I'm planning on staying in this longer term. So here's my structure, but the stock gapped up. Can I get this down to only a 1% risk by moving the put up now? So instead of what I just showed that, Victor, I might have done, had I not had the call in place, that other income method, we would sell to close the 130 put again, roll up to the 135, that debit we saw of 250. Max risk goes up to 5.2%. How is that possible? I should have lowered the risk. Every time I've done this, swapping the put up in price, I've seen a lower risk, but my return stays around 5.6%. The risk did not increase to the downside. The risk increased to the upside because now I've added this extra debit, which puts my total cost basis at 137.12. I have a guaranteed exit at 135 for the put. So that's only a 212 risk. Where is this 712 risk, maximum risk, coming from? It's coming from the fact that I sold a 130 call, a call that is now below my existing put strike price. So as the stock moves up, this current put that I have is losing value, and I'm not gaining any more positive delta on the stock. I've actually created a bearish position, which if we could send this out further, you'd see it looks more like this, where the risk up to 712 is in the upward direction where the stock is moving and where I thought it was originally going to continue to go. This is a no-no. Now, I know I have so many options here that are open, but you never want to sell a call below the put strike price or below the cost basis of the position. You don't roll the put up in strike first to lower risk until you handle the obligation of the sold call, which is canceling the positive delta of the stock in the married put structure. You have to do that first and adjust the put first. I'm sorry, adjust the call first before doing the put, Victor. You're exactly right, because I had sold a call. If I hadn't have sold the call, Victor, I would have done it again just as we showed. I might have even gone up to the 140 if it would have taken the risk down to 2% or so. But all that being said, that's where we are now with the ANET position. That's the right risk I was looking for. I must not have included the second put when I showed selling the call the first time. This is where the position stands right now, and I'm very comfortable with it. Didn't want to have a knee-jerk reaction, but next week I wouldn't be surprised if Fusion subscribers see me roll this, convert it to maybe an income method number 6. Most likely I'm just going to roll it, though. Now, if it gaps up to 135 or 140 on Monday or Tuesday, yeah, it's going to be harder to make an adjustment on. I'm going to have to consider something else in that case. It's not impossible to do, following the rules in the blueprint, but I might be going further out than I'd initially want to in that case. So that's just some of the concepts of the married put structure, why it's important to start with the limited risk in place initially. See things like Funko, see things like Meta dropping 25%, Funko dropping 50%. You guys remember a couple months ago I said I was going to get into it. It was at 19, it went up to 22, went up to 26, crashed to 18, came back up to 20, market fell again. I was just watching this little $20 stock. Never got into it, never played it, never did a married put on it, though it came up in the list. And it dropped 50% today. So thankfully, the only way I would have played it was with a married put. I still might have had a 7 or 8% loss, but it's better than doing covered calls on it, still ending up with a 40, 35% loss on the overall trade. Okay, 1 second, folks, excuse me. Sorry. Oh, where I was continuing there, of course, that's why the blueprint is important, because you can get yourself into trouble by making too many adjustments that you see on these webinars for free without the full education of when, how, and why to use each of the 12 different income methods that are shown and the positions in the blueprint course itself.